Alright, what's going on, guys? My name's Alex, and here today I have a video for you talking about dividend growth investing. This is an investing strategy that specifically targets dividend growth companies. And if you look at my portfolio here, I named it passive income. So that is the main focus for this portfolio, is creating a form of passive income by investing into the stock market. I have individual stocks here that I've invested and created pies here in my M1 Finance portfolio. You can see my current value right here in the top left corner. I started my portfolio on July 22nd, 2019, around my birthday. Which at the date of this video, it is June 29th, I believe. So we're almost at a year since I've made this portfolio. So it's been a journey. So now I have a year, almost a year under my belt. So I want to start documenting my journey investing in the stock market and dividend growth investing pretty much. I want to be, be an example, I guess. What you should and what you should not do. But yeah, so I wanted to begin documenting my journey and be very transparent and discuss with y'all many different things regarding investing, just finance in general. So if y'all have any questions or comments, please leave them in the description. Feel free to message me privately if you want, doesn't matter. But let's go ahead and take a quick look into my portfolio. So you can see the current value right now is at about 5,500 or 5,600 if you want to round up. Market gain today was a pretty volatile day. I believe the market went up actually, but market gain is down. But what I really pay attention to is the earned dividends. And so far I made $113. Which is not that bad. I mean, it's not going to blow you away or anything, but to think that I didn't have to work a single hour to earn this money right here is, it's significant. And eventually, I just want to get it to the point where I can retire early and just live off, my portfolio. So that is the ultimate goal, and hopefully someday in the future, I will be able to achieve that and you guys will be there. But for now, $113 isn't much, but you know what? It's better than nothing. It's better having your money work for you and doing something rather than just sitting in a checkings account or spending it or having it in a savings account, which I usually, I have some savings. But at the moment, with the whole outbreak that's been going on, can't say it because I know how YouTube is. The interest rate right now is below zero, essentially, or almost, at 0%. So banks aren't offering the best interest rates at the moment. So I feel it is a lot better and a lot more rewarding to invest it into the stock market at this moment, because at the moment the savings account, at least mine that I have, is only paying out 1%, which is compounded daily, which isn't bad, but it doesn't even beat inflation for every year. There's about 2%, so that 1% doesn't make a whole lot of a difference. But I guess if you're not going to invest into the stock market, you might as well open up a high interest savings account and do it that way, because it's better to have your money doing something than nothing. Yeah, so earn dividends, that is the goal. Right now, I think I'm sitting at about $14 a month. I'm averaging about in between $10 to $15 a month right now, which isn't too bad. I mean, I definitely didn't think it would be that high at this point. I mean, I didn't think, this isn't a get rich quick scheme or anything. This is just determination and, will pretty much to, work at your job, whatever you do. I'm a server. I do work in the serving industry. So that's how I make ends meet. That's how I pay for things. and that's how I put money into this portfolio. So that's what I'm doing right now. I am about to graduate college. I'm actually about to finish 2 summer classes, and I have 1 more summer class, and then I'll be done in August. So pretty exciting. The next couple of weeks are going to be grind, but I know that, it's going to be worth it. And the outlook is, hopefully going to be rewarding. I have a job as well too, hopefully lined up. But again, with everything that's been going on, it's not promised. Let's go ahead and put it that way. It's not promised, but we can always be optimistic about the future. And with that said, let's go ahead and take a look at my portfolio. Oh, before I get into the portfolio, I just wanted to make a disclaimer that I am not promoting any one of these companies. I'm not a financial advisor, so don't listen to a dude on YouTube talking into a microphone. Don't take my advice. Just do your own research and look at the facts yourself and make your decisions that way. So let's go ahead and look into the portfolio. So I have about, I think, 9 or 10 different slices here, and they're all divided up into different sectors of the economy. So real estate, healthcare, utilities, financial, which is like the banks and everything, telecom. I have a dividend ETFs and some bonds right here as well too. Consumer spending, technology, of course, and industrial. And the way that I've allocated these is I have real estate and healthcare at the top, and utilities as well too. I really like these sectors because for the most part they are pretty predictable, and there's a good amount of decent companies in these sectors. So I always like to put most of my money into more safer, less risk type investments. But again, the goal is having a healthy growing dividend, and most of these companies for the most part are really, really good at doing just that. And then if we take a look at financial and the telecom and our dividends as well too, financial, we have all of our banks and everything too, which the banking system is the banking system overall right now isn't doing too bad, but obviously there's some that are better than others, which I will talk about in a moment. Telecom, I mean, everybody needs a cell phone. Everybody has a cell phone. So, I mean, phones are not going anywhere soon. And dividend ETF and bonds, it's always good to have some form of ETF. It just helps with the whole diversification aspect of making a stock portfolio, is having those not promised, but those low risk securities for when times like this happen and we're going through a downturn and economic crisis, I guess you could say. And then we have consumer, which is like, going out to the malls and you see the Nike factory, for example. Nike, you can invest in Nike, of course. Nike is a global company, and it is recognized everywhere in the world for the most part. Yeah, pretty self-explanatory. Walmart, another good example as well too. Technology, I mean, Apple, Microsoft, one of the 2 biggest companies, if not the biggest companies in the world. And then we have industrial, like having the oil companies, Chevron, Exxon. And we can go ahead and take a deep dive and just look at the specifics right now. So right now we have the real estate sector. And in real estate, we have Realty Income Corp, which is a REIT. If you don't know what a REIT is, it stands for a Real Estate Investment Trust. And the thing about REITs is, for the most part, REITs have high payout ratios, which I believe they are required to by law. But usually REITs pay out about 70 to 90% of their net income to shareholders. So they are very cash heavy, and that's why I have them sitting at the top of my account. And if you look, we have Realty Income here. Realty Income is one of the best REITs, if not the best REIT. It has predictable cash flow, and it has over 6,500, I believe, properties, if not more, definitely, in which they are getting rental income for. They are leasing out office buildings and warehouses and all that stuff too. And they own a couple movie theaters as well, which movie theaters at the moment are not doing too well, but I'm pretty optimistic, and I like to believe that people do enjoy going out to the movies. It is, something to pass time, some, form of experience, and nothing beats seeing a movie on the wide screen. So I don't think those are going to be going anywhere, but they are definitely suffering right now. But Realty Income, one of, if not the best REIT out there at the moment. And then we have Simon Property here. Simon Property Group, they have leases for malls. They own malls, and they have a bunch of high-class malls and a lot of luxurious brands in those malls, and brands that can pay their leases and everything too every month for the most part. They do own a lot of movie theaters. I think it's about like 5 to 10% of the portfolio is movie theaters, but like I said before, I think those will do just fine. But right now they are definitely suffering. I acknowledge that. But Simon Property, they've been beaten up pretty good lately, so that's why I'm down at the moment. I've been just trying to dollar cost average for a little bit now, so I will definitely be buying more of Simon Property, because I do believe that malls are definitely not going anywhere anytime soon. And Store Capital, pretty similar to Realty Income Corp, except they are a lot newer and they have less of a track record, but they do have diversity on their side, and they do have a great portfolio size, and they do have a track record of growing their dividends, and I don't think they're going to be stopping anytime soon unless something really crazy happens and maybe they just lower their dividend a little bit. But even if they did that, not too bad of a company. So I like Store Capital. Welltower, they own senior living complexes. So when people retire, sometimes they go into a nursing home where they can get attention 24/7 when they need it. Welltower provides that, and they collect rental income that way. So Welltower is one of the companies that have recently slashed their dividend, but I'm going to continue to own them for this foreseeable future, because I do know, because I do acknowledge that the baby boomer generation is going to be retiring sooner in the next couple of years. So I believe Welltower has a lot of room for growth in that sense. And NRZ and Apartments, these are two stocks that I haven't been really bullish on, but I just bought for the most part just to generate some cash flow. And that's exactly what they've done. NRZ and Apartments. NRZ is a mortgage REIT, so they're very risky, and at the moment the housing market isn't too, people aren't too keen on buying a house at the moment. At least for the most part, majority of people aren't looking to buy a house. Preferred Apartments, they own obviously apartment buildings, and I don't think that's too bad. I am kind of more bullish on preferred apartment communities than NRZ, but I don't know. I think that I should be investing more money into these four REITs just because I believe that they're capable of growing their dividends for the foreseeable future. That's going to be it for the real estate sector. If we go down to the healthcare, we got Johnson & Johnson. We all know who they are for the most part. Johnson & Johnson, they have baby powder, they got baby lotion, and, pretty much any health-related skincare, not even just skincare, just health care products in general. Johnson & Johnson has a very large portfolio in that sense, and they're one of the best dividend companies out there. So Johnson & Johnson is at the top of my portfolio here for healthcare. AbbVie, they do a lot of pharmaceutical work, and I believe they're getting to cannabis as well too. But we'll see how that goes. Very good company as well too. United Health Group, they're an insurance company, healthcare insurance. This company is incredible. Insane dividend growth. They are on just another level. So I'm planning on investing more into them. Pfizer, I believe, another pharmaceutical company. Pet meds. Pets do require medical help sometimes. They get hurt. They need shots. They need pills for their worms, or they need medical help as well too. And I know we all love our pets and we want them to live forever, so we buy medicine for them because we love them. And that's why Pet Med is in my portfolio, because I see a lot of growth in that industry, and Pet Med has a great market share as well too. I think about like 20 to 30%. It's not too bad. And they have a lot of room for growth. CVS Health Corp, we all know who CVS is. They have a pharmacy and everything too. You see it every once in a while around the corner. Pretty self-explanatory. CVS, they have a really great track record of paying out their dividends and increasing them. So I like them. Merck & Company, they work with digital healthcare products, so new technology and all that. There's going to be a lot of demand in the future for products like these, so might as well get into it right now. And we have Cardinal Health. Cardinal Health offers healthcare services, surgery centers and stuff like that too. And they're fairly new, but they have a track record of growing their dividends, and I enjoy that, and they have a really good payout as well too. And that's going to be it for the healthcare sector. Go to utilities. I only have 2 utility stocks here. Comcast, they're an internet company. I consider internet a utility because, I mean, who doesn't have internet? And Comcast, they offer many services like regarding media, television, cable and all that, and internet, of course. So I consider them a utility. And Nextra Energy as well too. They are an energy company, obviously. So I don't believe that they're going to be going out of business anytime soon. And they also have a pretty good looking payout ratio, and they have been growing their dividend for quite a while as well too, so I keep them in my portfolio. If we go back, financial, take a look at this sector. So we have Aflac. They offer insurance, and everybody needs insurance, so that's why I have Aflac in there. Pretty predictable income. And we have T. Rowe Price Group here. They handle retirement accounts as well too. So if you have a 401k with their company or a retirement account with them, then you probably have T. Rowe Price Group somewhere in that mix. And we have JP Morgan. Pretty self-explanatory. One of the biggest banks, one of the best banks in my opinion. They have a great track record of paying out their dividends and growing it. It's looking pretty bleak right now for most banks, but I believe Chase is going to be able to get through it. We have American Express as well too. Just got my first American Express credit card, so that feels nice. I really like the company. I really like their features and credit card benefits and all that too, so I figured I would invest in them because I feel like they understand what consumers want and credit card users want in benefits and stuff like that for the most part. So I believe that they'll be profitable in the future. Wells Fargo. I used to like Wells Fargo. I have them for a checking account, kinda-ish. I use Chase a lot more. Wells Fargo, I really don't like. I don't like their business practices and all that. In terms of a dividend company, I mean, if you want them just for the dividend, I mean, that's all right. But I just don't want to be investing into any companies that I actually don't like. Because in a way, I feel like I'm supporting them. So once this creeps back up to, towards the green, I might just sell it off eventually. So out of the financial sector, we'll go to the telecom, AT&T, Verizon. Y'all don't need any explanation for that. You guys know who they are. I got my dividend ETFs here. I got some aggregate bonds right here. So this is like a treasury bonds. Well, not treasury bonds, but bonds from the government. So it's kind of like an index fund clumped together. So they're pretty diversified. They have a lot of corporate bonds and all that. Then we have SPHD. This index fund looks for the top 50 highest dividend companies in the S&P 500 and also the ones with the lowest volatility, and basically just comprises them into one portfolio right here. And you have a low volatile, high dividend ETF that pays you dividends every month. So I really like that. Monthly dividends are nice. So I invest in them. Schwab US Dividend Equity ETF, pretty similar to this one, but I feel like the metrics used in the Schwab ETF is a lot more rewarding, I guess you could say. The dividend is not monthly, but it comes every quarter and it's fairly good. Make sure to check that one out. Do some research on it. So get out of dividends. Go to consumer spending right here. Like I said in the beginning, got Nike, no explanation there. Coca-Cola, no explanation there. Walmart, everybody knows who Walmart is. Walmart is a global brand. Walgreens, Boots, and Alliance. Pretty similar to CVS. Colgate, investing in toothpaste. Everybody needs toothpaste for the foreseeable future. Don't see that going anywhere. Home Depot's been flourishing between this rough time. Everybody has a lot of time in their hands, so they're going out and doing, do-it-your-own projects and all that. So Home Depot is going to be doing good for as long as they have their doors open, honestly. And Disney, we all know who Disney is. We've seen Disney movies. Wanted to go to their theme parks as well too. Those are shut down at the moment, but I think long-term Disney is going to be a really big player in like the entertainment industry. So we get out of consumer, we go to tech, and like I said in the beginning, Apple, Microsoft, no explanation there. Visa is also one of those companies I think is very undervalued. I mean, it's really expensive right now. If you look, $191 looks expensive, but with their yield and the potential growth going into Visa, I mean, as a server working in the serving industry, I see nothing but pretty much just Visa cards that people use. I mean, Visa is growing at a rate that is unbelievable. And I just think that they have a lot of room for growth in the future. And I don't see them going anywhere for the next 15, 20 years at least. So if we go out to tech, go out to the last sector, the industrial sector. Here we have waste management. They handle trash. They pick up your trash on Sundays or Mondays, depending on where you live. They pay out a pretty good dividend. The growth with waste management is pretty concerning. Had to figure that out, but for the most part, I mean, they have been consistently paying and consistently raising their dividend for as long as that I've had them. So no complaints to waste management. GD, General Dynamics, they are a aerospace company and they work with military defense, I believe, as well too. So those are always needed. Dover, another industrial company, they supply materials, concrete and stuff like that as well too, which we need for infrastructure and everything. Exxon Mobil and Chevron, oil companies, they provide gasoline, pretty high class, or not high class, but high quality gasoline for the most part. They are really big companies, one of the biggest oil companies there is, and they have large yields as well too, which might be suspended. At least Exxon's might be, but we have yet to see that. I mean, there's no evidence, but people have been speculating, but people are always wrong. So I don't think they're going to be going anywhere. I think oil companies are pretty subsequent to like getting bailouts from the government and everything too. So I don't think they'll be going anywhere. All right, and I believe that's the whole portfolio for the most part. I promise to go a little bit more in depth as we go on with this this journey that I have. But an idea in the future, I'll probably post an update video of the portfolio every at least every week. Maybe I'll get like an actual specific day on when I'll be releasing that weekly video. But every week I'll be giving an updated look of the portfolio, and eventually I'll be reviewing every sector, make its own video for every sector, and just giving in-depth analysis on the companies that I have. And if you have any suggestions or any questions, then please leave them in the comments below. And again, message me as well if you would like to do that in private. But I just wanted to say that I want to create these videos about finance because I want to hopefully inspire somebody to begin investing, or hopefully motivate somebody to move towards that goal of creating another form of income so they can stop working, long hours, or quit that second job, or, fill something in the gap that can help them not have to work as hard, or not have to strain yourself, physically and mentally, because I know how hard that can be. And it seems like there's not a way out or a different path that you can take, but I promise that there always is another way. And if you have that motivation and that determination, then I honestly believe that anybody could become wealthy. And that's what this whole portfolio is meant to be, is the way to create wealth. Not make you super rich, make you millions and thousands, millions, hundreds of millions of dollars, just to make you wealthy. There's a clear difference in both of those terms between rich and wealthy. So with that said, I hope y'all enjoyed. Make sure to like the video for the YouTube algorithm, as Graham Stephan would say. And don't forget to subscribe for more content. But besides that, I will see you guys in the next video. Peace.